This year, we're going to continue our webinar series, and we will aim to discuss emerging topics within the environmental science sector. And we will continue some of the series that we're doing alongside the Entrepreneurship in the Environment webinar series as well. So today's webinar, Streamlined Energy and Carbon Reporting, the Future of Energy and Carbon Reporting, will be jointly presented by James Tapson and George Baker. So James is a senior consultant and George Baker a graduate consultant in the Sustainability and Climate Change team at WSP. So James has 5 years of sustainability consultancy experience, during which time he's had focus on carbon and resource management both in the UK and internationally. George specialises in corporate environmental and sustainability management across multiple different sectors, supporting the delivery of a number of high-profile sustainability strategies. So today, the two of them will unpick the SECR, what SECR covers, and discuss some of the practical steps organisations can take to ensure compliance in 2020.
First of all, thank you for taking time out of your day to join the webinar on Streamlined Energy and Carbon Reporting. First of all, I'd like to thank Rihanna and the IS for hosting us. Really thankful for that. So as Rihanna said, my name is James Tapson. I'm a senior consultant here at WSP in the Sustainability and Climate Change team. Been working in the industry for almost 6 years now. Majority of my work is split between working for corporate clients on greenhouse gas management and sustainability strategies. And also the other half of my time is spent on carbon management on large infrastructure projects, most recently on HS2 and Crossrail. So I'm joined by my colleague George Baker, who I'll let introduce himself now.
Thank you, James. So I'm George Baker, and I'm a graduate consultant in the Sustainability and Climate Change team at WSP. And I've been working at the company for just over a year now. As Rihanna mentioned, I specialise in corporate environmental and sustainability management, and this is across multiple sectors. And I've supported the delivery of a number of sustainability strategies. This has included the delivery of the Airport Carbon Accreditation Programme. This is also known as ACCA, and this is the only institutionally endorsed carbon management and reporting certification standard for airports. I currently account manage more than 50 airports, and we recently reached 250 included in the scheme globally. I've also co-authored a white paper on the circular economy. This was actually as part of my thesis on my master's at the University of Leeds, and that was ultimately how I was introduced to WSP.
Just to go over the agenda for today, we firstly like to give a brief overview of WSP, who we are and what we do, and just to highlight our experience in corporate greenhouse gas management. Following that, we like to give an overview of how corporate greenhouse gas management is currently covered, what current legislation is currently out there, and how the current framework looks for companies and how they report. George is then going to delve into what SCCR is, the drivers for its introduction, and look at how businesses which are under scope might be affected, and how the legislation that's currently enforced might change when SCCR comes into effect. We'll then delve into how businesses who are affected by the regulations will need to report, and then set out the timeframes for how they should be delivering these reports to government. Finally, we've got a brief overview of a few key questions we've been receiving from our clients over the past few months on SCCR. So we've developed a set of frequently asked questions, which we've got answers to that hopefully answer a few of the burning questions a few of you might already have. And then we've developed 5 simple practical steps to managing SCCR, covering all of the items discussed in this presentation. And finally, towards the end, I think Rihanna will be collecting your questions, which we will answer towards the end of the session. So please feel free to type those in the chat box as we go along, and we'll aim to answer as many as we can at the end of the session. So for a brief introduction to WSP, for those who don't know who we are, we're one of the world's leading engineering and environmental services businesses. George and I sit within the environmental practice, which is one of the largest in the UK. And we're a combination of environmental scientists, engineers, and management consultants, which allows us to both offer strategic and deeply technical hands-on services to our clients. We work across the built environment, across energy, across industry, property, transport, and infrastructure, providing significant technical expertise and also acting in a trusted advisor role to large businesses on energy and carbon issues. Recently, we've had significant expertise in the ESOS scheme, the Energy Savings and Opportunity Schemes, which a few of you might be aware of, and the Minimum Energy Efficiency Standards, or MEES. And we're also a registered partner with the Carbon Disclosure Project in the UK and the USA. So just to give a brief overview on what we mean by corporate carbon management. So a few of you may be aware of this, so hopefully it's not teaching you to suck eggs too much, but for those who are new to carbon management and how it works in the corporate space, I was going to give an overview of that. So when we talk about carbon emissions, we're not just talking about carbon dioxide, but using the word carbon as a proxy for all 6 greenhouse gases. So carbon dioxide, methane, nitrous dioxide, hydrofluorocarbons, PFCs, and SF6. So when we talk about greenhouse gases and carbon, we're referring to all 6 of these greenhouse gases. And usually this is typically reported by businesses as a carbon dioxide equivalent. So you might see the metric CO2e as the unit that people use to report their carbon emissions in. Based on international best practice, which is typically the Greenhouse Gas Protocol corporate guidelines, businesses will report their emissions under 3 scopes. So scope 1 are direct emissions generated by the business through combustion of fuel in their operations or in their company vehicles. So if you have a boiler on site and you burn gas in that, or you have a fleet of trucks and you burn fuel in those will be your scope 1 direct emissions, which you will report on. Scope 2 emissions, pretty straightforward, are just the purchase of electricity, heating or cooling for your business. Anytime you flick on the switch in your office or turn the kettle on, that's using electricity, and that's your indirect scope 2 emissions, as you're purchasing that electricity from a third party. So these are the 2 scopes that are typically most reported by businesses in the UK and is covered by the mandatory reporting regulations. However, many businesses go on to report their scope 3 emissions voluntarily. So scope 3 emissions cover your upstream and downstream indirect emissions. So this is whether a company, a third party, might be delivering goods to you, so the fuel they burn in their trucks, any carbon associated with the manufacturing of products that you purchase, and then downstream, looking at maybe the transport of your goods to another party, if that's managed by someone else, or the waste processes associated with disposing or recycling of the goods that you sell. Hopefully that gives a good overview of scopes 1, 2, and 3. As I said, scope 1 and 2 is typically mandatory, and most companies report this if they're in scope of the legislation, and scope 3 is voluntary. However, we see more and more businesses that WSP work with looking to report on the material scope 3 elements of their carbon footprint, particularly as many are now participating in schemes such as the Carbon Disclosure Project, CDP, or GRESB, which is an infrastructure scoring mechanism based on sustainability, of which carbon is a key factor for analysis. So I'll now pass over to George, who's going to delve into SCCR and what it might mean to businesses around the country.
Yeah, thank you, James. So before I jump into explaining streamlined energy carbon reporting, also known as SCCR, I shall provide a brief overview of where we currently sit. So this is with regards to the energy and carbon reporting and currently providing an understanding of what is actually going on. So in short, the current business energy policy framework is really complex. The government has a number of policies in place to encourage organisations to invest in energy efficiency and decarbonisation. And consequently, individual organisations can be in scope of multiple policies with similar levers. So for example, mandating reporting of energy use and emissions, or creating a price signal, as demonstrated on the slide. So those creating a price signal includes the climate change levy. Now this was introduced in 2001 and applies to most energy users, setting tax rates on energy usage with the aim of improving energy efficiency and reducing carbon emissions. Alternatively, other energy use and emissions policies require measurement or reporting. For example, the Energy Savings Opportunity Scheme, also known as ESOS, mandates large companies to report on future energy use and energy efficiency opportunities. Now, large companies here are defined as having over 250 employees or annual turnover of over 50 million euros, whereas other areas of the policies can be defined as different areas of, for example, large companies. So as a contrasting example, the mandatory carbon reporting regulations also requires reporting, but has a different scope. And this particularly looks at all quoted companies to measure and report on their greenhouse gas emissions. So building on James's previous point, this is mandatory for scope 1 and 2 emissions, but increasingly organisations are voluntarily reporting scope 3. So finally, multiple policies create both price signals and reporting. So the EU emissions trading system, set up in 2005, encourages emissions reductions through the cap and trade principle, enabling companies to trade emissions through allowances when in surplus. However, there is increasing uncertainty over the future of the EU emissions trading system, particularly with its relationship with the UK after Brexit. Separately, the climate change agreements are voluntary agreements to reduce energy use that in turn allow for reductions in the previously discussed climate change levy tax. And this includes up to 90% reductions on the tax for electricity bills. Then, the Carbon Reduction Commitment Energy Efficiency Scheme is a further mandatory carbon emissions reporting and pricing scheme, this time focusing on both large public and private sector organisations in the UK, and that use more than 6,000 megawatt hour per year of electricity. So as this demonstrates, there currently seems an overwhelming and complex amount of policies related to energy use and emissions. So this is where SECR comes into play. I noticed there's a couple of questions, such as Carl. We're essentially going to answer all questions at the end, but please feel free to write in the questions as we go through them, and then we'll address all questions at the end. So what actually is SECR? So it is essentially a new reporting framework for businesses operating in the UK to report energy usage and carbon emissions. So this was developed following the 2016 summer budget, where the UK government consulted on a review of the business energy efficiency tax landscape and recognised that there was a need to improve the effectiveness of the current complex regime, as demonstrated in the previous slide. So SECR aims to improve and simplify this, ensuring that the robust data is available for businesses to act to reduce their emissions, in turn making it more efficient and effective for companies to report. This will encourage many more businesses to quantify consumption in a consistent and comparable manner, leading to further actions to be taken to reduce their energy consumption. So as a result, both energy and cost savings should be achieved. The government anticipates that a huge 4 terawatt-hour of energy will be saved every year. So to comprehend this, this is just over 15% of the whole of Scotland's annual energy usage. As a result, this is expected to lead to a total reduction of 1.3 million net direct costs for businesses, and from a wider perspective, deliver a net societal benefit the government estimates could be over 1.5 billion. This includes sort of examples including savings in air quality, reductions in noise pollution, and reduced land take from the likes of power plants, and so on. It must be noted that these estimates are based on the combined package of not only introducing SECR, but closing the carbon reduction commitment and increasing climate change levy rates. These amendments should be explained in more detail later on in the presentation. So there is also some environmental benefits. From an environmental perspective, we can contribute against the government's current carbon reduction targets. So at this point, I'm going to ask the audience a question. So do people know what the current target reduction is as a percentage for 2050 compared to 1990 emissions? And I'll give us about 30 seconds to a minute to answer this question. And yeah, any you're welcome.
Please feel free to type in the chat box, and we'll give you the answer in about 30 to 45 seconds. So please feel free to interact and let us know your thoughts on what you think the target is. And quite a lot of people in similar ballpark there, so it's interesting to see.
Yeah, so as sort of a mixed array, but all in the higher spectrum, which is moderately surprising. So yeah, 80% is the correct answer. So well done to several of you. And we often find a common perception that is people that underestimate this total, that sometimes people think it could be less. Now, to meet these targets, the government has prepared 5 yearly carbon budgets, and this is highlighted by the dotted green line in this graph, and this runs until 2032. And these essentially restrict the amount of GHG emissions the nation can emit over each 5-year period. However, meeting future carbon budgets and the Climate Change Act will require reducing UK emissions by at least a further 3% per year. This will require existing progress to be supplemented by far more challenging measures, with SECR being a key focal point from 2019. Now, the government also has more short-term targets, with an overall target to improve business efficiency by 20% by 2030. Now, this is one of the single largest carbon saving measures announced in the recent Clean Growth Strategy last year, and is expected to require an additional £23 billion in private sector investment to achieve. So I'm going to ask the audience a further question. As an additional question, what percentage do we think business and industry make up of the total UK carbon footprint?
Again, please feel free to enter your responses in the chat box, and we'll give you another 30 seconds to see what the audience thinks is the is the total business and industry footprint compared to the whole UK footprint. Great,
yeah,
we're close to that there.
So there's some yeah. So actually, that's pretty much spot on. So basically, as demonstrated in the chart, business and industry are the most important sector. Perhaps not quite as much as some estimates, but yeah, they are increasingly the most important sector, and they're an increasing focus point from this legislation surrounding SECR. So there is a lot of work currently being targeted in the transport sector with regards to carbon targets, such as HS2 and Crossrail. So HS2 has an incredibly ambitious carbon reduction target of 50%, and similarly, the power sector is already going a long way to green the grid, as seen by the increasing rise in the use of renewable energy. So the government is now taking the next steps and targeting the business and industry sector, introducing these new legislations. So what is actually going to change? So before we delve into what is going to change, it must be noted that the Department for Business, Energy and Industrial Strategy, also known as BEIS, is yet to publish the final guidelines on how to comply with SECR. These are expected to be published later in January. However, we don't anticipate significant changes from the current guidelines, perhaps just a few further clarifications and detail, but no wholesale changes. So, as it stands, significant change is being made to key business legislation. These changes include amendments to the Companies Act, the large and medium-sized companies and group regulations, and the limited liability partnership regulations. For those of you wanting a bit more detail on this, there is a 19-page document that details these regulations and how this will amend existing regulations, and this is accessible online. But please contact myself or James if you would like a copy of this or a bit more detail on this. So the overarching change from these amendments is the increase in mandatory energy and carbon reporting for business. Separately, from the end of the 2018-19 compliance year, there will be closure of the previously addressed CRC. Therefore, to make up for the loss of revenue from closing the CRC, a subsequent increase will be introduced in CCL rates from April 2019. This will be done through an increase in the rates charged via utility bills. This involves the ratio of the electricity CCL rate to the gas CCL rate changing from 2.9 to 1 to 2.5 to 1 from April 2019. In the longer term, the government announced its intention to rebalance CCL rates to reach a ratio of 1 to 1 of electricity to gas by 2025. So additionally, there will be no further obligation to monitor gas and electricity under the CRC in the energy efficiency compliance year. So as a result, it is estimated that up to around 11,900 companies, 11,300 after exemptions, 230 limited liability partnerships, and 50 unregistered companies will be affected by these changes. And that's a near sevenfold increase from the existing MCR. So it must be noted that previously mentioned ESOS is not impacted by SECR, and both will run as complementary frameworks to drive energy and GHG reductions. However, we will mention a little bit further on the ESOS-SECR relationship later on. So moving on to the next slide, am I in scope? So a lot of you would be interested to understand as to whether this really affects yourself and if you're in scope for the updated regulations. So it's proposed that the SECR framework will only apply to companies formed and registered under the Companies Act 2006. This means that organisations which are not registered as companies, for example, public sector organisations, some charities, and perhaps some private sector organisations such as certain partnerships, may not be in scope of the SECR framework. The quoted companies that are registered under the Companies Act 2006, the simple answer is yes, and this has been mandated under the Companies Act. Then, if you are a private company, whether you're in scope depends on the size of your business. So, if you're a large UK registered unquoted company with 2 or more of the following, you are in scope. So these include more than 250 employees, an annual turnover of more than £36 million, and an annual balance sheet greater than 18 million, then you are definitely in scope. It must be noted that there are a few exemptions. So companies using lower domestic levels of energy are not required to disclose their SECR information as if they can confirm they use 1,000 kilowatt hour or less in a 12-month period. Comply or explain exemption has also been added, allowing unquoted companies to exempt a proportion of their energy use and emissions from reporting, provided they can explain why it placed a disproportional burden on them to report this data. The government also has an exemption that if the company feels the reporting will be prejudicial to their business, it must be noted these criteria will be set by the government and will be determined on a case-by-case basis. Importantly, if you feel your business will meet one of these exemptions, you are still required to submit a report under SECR, explaining why you believe you're exempt from disclosing your energy and carbon data. When published, this is where we feel the final guidance document will provide a little bit more clarity, but what each type of business reports on and how this is reported will be different depending on whether you're a quoted or unquoted company. So I shall now pass you back to James, and he'll explain this process.
Thanks, George. So yes, if your company meets one of those thresholds, then you'll need to report on different items depending on what type of company you are. So if you're any type of company that fits that, so a quoted or unquoted company that meets the thresholds, we have to report on the first 4 items in this table. So first of all, you need to report on your energy use from your UK operations. So whether this be from electricity on site for lighting, burning gas in boilers, or utilising energy from on-site solar PV, this will need to be reported as a total figure in kilowatt hours or megawatt hours, depending on how large your business is. And typically, you'll get that information from gas meters, from electricity meters in your property, or from any bills that you might have from your suppliers. Companies will then also need to report on energy use in transportation. This will typically probably be from litres or gallons of fuel burned in owned vehicles. As we talked about earlier, it will be mandatory reporting your scope 1 and 2 vehicle emissions. So this will be from burning fuel in your own company vehicles, any electricity used in electric vehicles, or any fuel burned in vehicles that you lease from another person, but you're responsible for fueling and running that vehicle. It will be voluntary to report on scope 3 or indirect vehicle emissions, which might come from other businesses transporting goods on your behalf, or from staff commuting and business travel. So again, while scope 3 will be voluntary, due to the rise of initiatives such as the CDP and the Science Based Targets Initiative, more and more large businesses that we work with are actually beginning to report these as more of their stakeholders are looking for evidence that they're running a sustainable business. So from the data collected for energy usage for on-site and for transport, we'll then need to go on to calculate the associated greenhouse gas emissions. So on the next slide, I'll talk about how the calculation will actually be undertaken, but the total greenhouse gas figure will need to be reported. And as I mentioned earlier, this will be in the form of a total CO2 equivalent number. So tons of carbon dioxide equivalent will be the figure you report your greenhouse gas usage in for your UK energy use. Alongside that, you'll also need to produce an intensity metric. So this is essentially a ratio of your total greenhouse gas emissions against a quantifiable business metric. The exact metric you can use will be defined in the guidance we're expecting later this month, but at the moment the government is suggesting for your energy, you'll use a kilowatt hour per metre squared basis, so for how many metres squared of office space you have, how much energy you're using per metre square of office space. And for greenhouse gas emissions, it will be currently suggested to use a tons of CO2 equivalent per full-time employee, so per employee of the business. There's also potentially scope in the future to do it per pound of revenue generated by the business or per product sold. So we'll look out for the final guidance that should be coming towards the end of this month. But those are the current metrics the government is looking at for businesses to be reporting with. For quota companies only, there's a bit more of an administrative burden here. So they'll need to be reporting on their global energy usage. So as per the first box, they'll be looking at the combustion of gas, electricity from their global operations, and then also reporting a greenhouse gas figure for that global energy usage as well. This can be potentially a lot more tricky, as they'll have to liaise with a lot more stakeholders on a global scale and also find carbon emissions factors, which I'll come on to later, for those specific countries that they work in. So that's the main elements of carbon and energy reporting, and then there's an extra requirement from the government, and this is where it links in with the ESOS requirements. SECR will require you to report on any energy efficiency measures you've made over the past 12-month period. So this could be if you've installed LEDs over the year, if you've installed ground source heat pumps in your buildings, solar renewable energy on site. So any measures like that where you've taken a distinct step to increase your energy efficiency, this should be reported. This links in quite well with ESOS because as part of ESOS you'll be identifying energy efficiency opportunities, and through SECR you can report on how well you've done with that. So that's what you need to report. How you might go about reporting that. So this is kind of a job that we take on behalf of a lot of our clients in terms of collecting the data and calculating the data. So as a business, you'll need to start setting the processes in now to start collecting that energy data from your premises and talking to stakeholders about how you might go about doing that. So you'll be collecting data from your energy meters, also might be using data directly from your supplier invoices or bills. So any bills you get from your British Gases or your E.ONs, that should be collected and used to calculate up your total kilowatt hour usage. For transport energy data, that can be a bit more tricky. So you'll typically need to be collecting data from your fuel usage in your vehicles. So this might be the litres of fuel used in your trucks. If you've got fuel purchase cards that your company uses, you'll need to be using those as well to look at how much fuel you're using. But potentially you might be calculating back from miles travelled by your vehicles, calculating back with a miles per gallon ratio you know for your vehicles, and using that to work out how many gallons of fuel you've used. You'll also need to be, as I say, collecting information over the year on your energy efficiency efforts taken. So how many LEDs you fitted, how many solar PV array, how much solar PV you fitted onto your site This information needs to be collected throughout the year. Finally, once you have all this information collected, you need to then calculate your greenhouse gas emissions. This is potentially a more labour-intensive process, and you'll need to make sure that you are using published industry sources for those carbon emissions factors. The carbon emissions factors, for those who don't know, are used in order to report greenhouse gas emissions associated with your activities. So it's a way of converting up from the kilowatt hours or litres of fuel used into specific carbon dioxide equivalent values. So emissions factors would typically be a ton CO2e per activity unit, so a ton of carbon per kilowatt hour, or a certain number of tons of carbon per litre of fuel burned. Again, these are all available for the UK through DEFRA. They publish a set of updated carbon factors each year on their website, so I encourage you all to go look at those and download the most recent sets to familiarise yourself with carbon emissions factors. They'll have them there for different fuel types. They'll have them there for the UK grid, so you can calculate up your energy usage emissions factors, so emissions total from that. So as I said, that's for UK companies. You can easily go to DEFRA and find those emissions factors. And for quota companies, it might be a bit of a trickier job, as you'll need to find emissions factors for the grid in countries where you have operations that use electricity. So if you've got warehousing out in Italy, you'll need to make sure you find an Italian emissions factor for the grid out in Italy. This might be a tricky task. There are published sources for that out there, but a lot of clients and ourselves use off-the-shelf industry tools that have those emissions factors embedded within them. WSP ourselves have our own calculation tool called GIST, which you can find out about online, which has emissions factors embedded within it. But for smaller companies who can just use the DEFRA factors, typically you can just undertake the calculations in Excel and calculate in there, ensuring you keep a good log of the methodology you've used and the emissions factors, and making sure that you're referencing which factors you've used and where they've come from. In terms of how the submission process will work, this will be an annual requirement. We'll talk about the timelines and deadlines in the next page, but this will be from April 2019, the reporting year will start. Quota companies will need to submit this as a statement within their annual directors report, so going with their normal filing with Companies House. And for unquoted companies, including LLPs, they'll need to prepare and submit a standalone energy and carbon report. The exact method of submission for this is not known yet, and we're hoping this will come out in the guidance the government will be publishing towards the end of this month. And so we're hotly anticipating that, and that should give more detail exactly how the process will work for unquoted companies. But there is ambitions for the government. They're already talking about a potential for an online portal, so it can all be done digitally to make it a lot easier for everyone to submit and for it to be tracked. Right, and in terms of when this all needs to be done by, so as we've touched on before, at the end of this month, we're hoping that the government will release their final set of guidelines for how exactly the regulations should be taken on board by participating companies. But because of the Brexit situation at the moment, this may be delayed, so we may be looking to February at the moment, but we're hoping in the next couple of weeks this final information should come out, so keep an eye out for that. And then from the 1st of April this year, the regulations come into force. So that's when people should be starting to look at setting in processes, starting to collect data, trying to look at where their gaps may be. And then from April 2020 onwards, the first companies will start to report. So quota companies typically will be doing the April to April reporting year, so maybe their first report might be submitted around May or June of 2020. But there is provision for unquoted companies who have a different reporting year. So if you have a July to July reporting year, and you're an unquoted company, there's provision there for you to report in line with your normal reporting structure. So you'll report for your period of July 19 to July 2020, so may submit your report in August or September of 2020. And so the government hope is that, yeah, by 2021 in March, all companies will have completed their first round of SECR reporting. So although it doesn't come until April, it's really important to start to think about the processes and the data collection process now, before the regulations come in and before they're sort of behind the mark. So I'm going to pass back over to George now, who's going to go through a few questions we've been receiving from clients and hopefully answer a few questions we might have already been having in the back of your mind.
Yeah, thanks, James. So we've already started speaking with a few clients about all this as the data does soon need to start being collected. And so these are 3 questions that we've really seen that seem to keep popping up and asking us, but we're also going to try and answer as many questions as possible from us at the end of the PowerPoint presentation. So we've already touched a little bit on ESOS in a couple of previous slides. We've had several clients asking about why there is now SECR and ESOS, asking sort of why they are different and how they are connected. And as there does seem to be some confusion on how they cross over, hopefully this provides some clarity. So in short, ESOS is looking forward. It's looking for opportunities to reduce the energy usage, flagging them for action. This does not mandate reporting on performance and what's been done. There is a very slight 12-month period to enable them to develop a baseline so that future planning and opportunities can be compared with. So in contrast, SECR is the reporting function, having specific provision on reporting what the energy efficiency measures have been made. So ESOS sort of plans and reports for the future, whereas SECR reports on what's already been done. So ESOS, in short, is looking forward. So this is looking for opportunities to reduce the energy, flagging them for action. This does not mandate reporting on performance on what has been done. There is an element of reporting in ESOS, but this is only looking at a 12-month period to enable this. I'm just checking. Is it okay? 12-month period, and this enables the development of a baseline when reporting over this 12-month period, so that future planning and opportunities can be compared with. So that's for ESOS. But in contrast, SECR is the actual reporting function, having specific provision on reporting what energy efficiency measures have been made. So ESOS plans and reports for the future, whereas SECR reports on what's been done. So it must be noted actually that both have different definitions of what classifies as a large unquoted company. So SECR defines a large company by having an annual turnover of more than 36 million. That's great, you can hear me. Whereas ESOS now defines an annual, ESOS defines an annual turnover of more than 50 million euros. So there's a difference between euros and pounds. SECR is in pounds. I think I noticed a question earlier on. SECR is with regards to pounds. So ESOS therefore currently includes larger organisations. However, this will change in accordance to the relationship between the pound and the euro. So the next question essentially looks at sort of the idea of being a UK-based group of organisations, but also having a parent company, and whether the parent company should be reporting or is everyone reporting. So essentially the parent company reports on SECR and it's their responsibility. As a subsidiary, you'll be likely to provide the data to the parent company. Therefore, if not doing so already, it would be advised to cross-check this with your parent company and ensure that they are aware and understand these regulations. Alternatively, if you are the parent company, it would be advised to then if you're the parent company, it'd be advised to then talk to your subsidiaries and ensure that they are aware of the regulations and also collecting the correct data. Parent companies should only be reporting on subsidiaries that themselves exceed the thresholds. So this should exclude any subsidiaries that don't meet the reporting criteria, i.e. less than 250 employees, etc. Saying all this, as a subsidiary, if you feel that you want to report, and you need to report, you can do so. This is purely in reference for UK groups, as international groups have different requirements, as explained in the next question. So, from an international group perspective, we also have several clients that have asked this question from an international group. So, therefore, if you're a UK company with a foreign-based parent company who is not quoted in the UK, it is your responsibility to report on your UK operations. So to provide an example of this, if you are a large UK entity with operations in China and America, you would not have to report on the entity's Chinese and American operations. It is only the UK operations that would be relevant. So to draw everything together and in light of what we've been said, we've developed a 5-step process to easily navigate SECR and hopefully summarise everything that we've spoken about in a sort of tangible process. So to start off with your approach to SECR, confirm you're in the scope. So to confirm inclusion in the scope of SECR, this is done by whether you're a quoted company or alternatively fit the Companies Act 2006 definition of a large company, i.e. have 2 or more of the following. So it's more than 250 employees, annual turnover of more than 36 million, and an annual balance sheet greater than 18 million. So once this is determined, you'd carry out a gap analysis of the current reporting against the published SECR guidance and agree a project plan. So as a first point of call, you would review the current data collection and reporting processes to ensure you are collecting the right data for SECR. Wherever possible, businesses should make use of their normal accounting and environmental management systems to regulate the collection of energy information throughout the year. So you can review the current extent and maturity of reporting to ensure it meets the correct reporting boundaries of the SECR requirements. If you have historical data on energy efficiency actions, these should be reviewed. You should then agree the steps that are needed to bridge the gap between your current position and then compliance with SECR. So this goes on to data collection. Now, as James mentioned earlier, you must be collecting data on things like energy usage, fuel usage, etc. Therefore, you must ensure that you have the correct people and processes in place to be collecting this data at the correct standard and quality. So you should also manage data collection processes with the key stakeholders and then define these expectations with the stakeholders. So once these processes are in place, you should then ensure that the data is collected and stored in a robust and consistent manner. And this guarantees that this is in the correct format to then enable the calculations. So then the next step from these calculations would be, as James mentioned earlier, be calculating the GHG totals. And these must be in line with international best practice standard, so such as the Greenhouse Gas Protocol Corporate Reporting Guidelines. Calculations would be typically developed through Excel spreadsheets. However, for large calculations, alternative tools may be advised, such as GIST. It must be noted that if these official tools are made, you must maintain records or any assumptions or emission factors used to be recorded alongside your methodology, as these will need to be submitted alongside your report. Then finally, once data calculation is complete, you should prepare and submit your report. Now, as a quoted company, this will be part of your annual director's report submitted to Companies House. As an unquoted company, this will be a standalone carbon and energy report submitted to BEIS. We would recommend that you obtain executive level sign-off prior to submission. Additionally, for both quoted and unquoted companies, it would be recommended that if you are not already getting a third party to complete this for you, acquire a third party to complete quality assurance. I think that answered a question earlier about third party quality assurance. So hopefully that provides an overview of the 5 steps to completing SECR. For more detail on this, we are currently developing an SECR toolkit, and this shall be launched towards the end of this month. So thank you very much for listening, and we shall now open the floor to any questions.
Perfect, thank you both. I've had so many questions come through, so it's great we've got a little bit more time to be able to go through them.
Right.
A little bit on what you've just touched on. A couple of people are asking whether there's some sort of template that people can use for reporting, like a standardized template that they can get hold of to report on.
Yeah, so within the guidelines, there's no specific template or pro forma for reporting. So it's just suggested that businesses develop their own templates that fits in with their current reporting standards, but just making sure that it includes all the required information. So essentially no template, but I'm sure if any people go to third-party providers, they'll have a good template for them, or work up one based on your current reporting structure.
Okay, and another question was, will submissions be subject to auditing by a third party?
So I think as submitting under Companies House, that will be audited. Companies House will ensure that the requirements are being met for any accounts that are submitted. There's also a auditing council that will be auditing Companies House reports. However, we also imagine BEIS will be doing a regulatory piece as well within this framework.
Okay.
But again, I think we're imagining when the guidelines come out towards the end of this month, there'll be specific guidelines in there as to how enforcement and auditing will work.
Okay. And another question, do charities have to report on SECR and third sector in general?
Yes, so I think it sort of relates to previous. So if your charity is registered with the Companies House and has at least 250 employees, basically all the areas of the unquoted company, so an annual turnover greater than 36 million and an annual balance sheet greater than 18 million, SECR will apply. So it's quite similar to usual business. Okay.
A couple of questions around enforcement. Who and how is non-compliance being enforced, and who is the body doing that?
So yeah, I sort of touched on that slightly in the previous question, but there's the Conduct Committee of the Financial Reporting Council will be responsible for monitoring company reports and accounts submitted to Companies House, and Companies House would also not be accepting accounts that don't meet those requirements. So expect that to be the sort of main auditing process for quoted companies. However, we're still waiting for the guidelines to see how unquoted companies will be audited and enforced. although we do know that within LLPs, all registered members of the LLP will be liable if the company does not submit the correct report come 2020, and that they were aware of that. So there is specific penalties for partners of LLPs should their firm not comply come 2020. Again, the actual extent of the fine or the enforcement hasn't been set yet, but this should be made clear in the guidance coming out in a few weeks' time.
Okay. One member is just asking us to just go back to this particular slide. I think either as a reference point or there may be a question that comes back in afterwards. So just move that back for now.
Sure.
A couple of questions around the scope, and back on slide 15 actually, if we can scroll back to that. Yeah. Is this figure purely scope 1 and 2 emissions only?
15, maybe 14 potentially, probably this one.
14, yeah. 14,
yes.
Sorry.
So yeah, this is scope 1 and 2 emissions. Yeah. Yeah. So yeah, this is scope 1 and 2 emissions from the UK. Yeah.
Okay. Okay. Brilliant. Thank you. I think that was just a bit of clarification. Clarification needed. And another question actually from Alice Berry. She said you mentioned that it was more efficient. That this is more efficient and will be much better for the UK, but just wanted you to elaborate on what these efficiencies are and how it will be better.
Sure.
Yeah. So the overriding drive for SECR was to sort of simplify and reduce like the complexities that are currently there. It's all a bit like that slide was a bit almost. There's too much on that slide just to show how sort of intense and complex it is at the moment. So there's still a lot of confusion surrounding this. So essentially, SECR aims to provide some clarity on this, ensuring that the data is available for businesses to act to reduce emissions. But there's also going to be a reduction in sort of day-to-day burden to business, such as sort of reduced paperwork and things like that. So as an example, looking specifically at the sort of CRC, which is going to be got rid of, this includes elements of emissions sort of trading in the buying and selling of emissions through allowances. These efforts will then obviously be removed if it's closed, and there will therefore be a huge relief to the industry, reducing sort of the administrative burden and replaced by the introduction of SECR. However, to actually sort of understand the full efficiencies, I think time will tell the full truth on that, because it hasn't been introduced yet. That's only until April 2019, and I think it's quite difficult to truly assess quite how sort of streamlined it is in reality. But it's definitely the right direction, but it's difficult to tell fully in reality at this point.
Okay. So John Logan's just asked a question down there, and he says, we are awaiting formal science-based targets covering all 3 scopes. Will CERC duplicate my reporting needs?
I don't think we'll duplicate, but we'll complement. So any of the work they've undertaken to develop a science-based target for their scope 3, I imagine they collected all their carbon data for that. That would just be readily available to be used to report in SECR. So with SECR, many of the energy efficiency and carbon reduction legislation is already in place. If you're under those scopes, you'll probably be collecting a lot of this data already. If you're already submitting under CDP, you're already submitting under SBT, Science-Based Targets Initiative, you'll probably have this data already. So it's not a duplication necessarily, but it will require an extra level of reporting. But hopefully a lot of the legwork's been done to collect the data. It's just a case of repackaging that into reporting that fits in line with this framework.
Okay. Brilliant. And apologies if you have clarified on this earlier. It was an early question that came in, but is the scope based solely on the pound figure and not conversion from euro?
Yeah, so it is purely for the pound, and then basically, yeah, the ESOS does look at the euro. So as it stands currently, ESOS is sort of larger, or it includes larger companies, because that's for 50 million euros compared to sort of 38 for SECR. So it's actually, if you look at the current exchange rate, it's bigger, but this is going to vary a lot. But SECR is pound, and ESOS and others like that are for the euro. Okay,
brilliant. And in case people missed it, the IES does actually hold a register of professionals that act as ESOS lead assessors. We're not currently accepting any new applications onto the register, but we are accepting transfers. So You can save yourself a lot of money if you want to look at that in a bit more detail. It's all on the website for more details, or you can contact us at the project office if that's going to be of any use. I think that's the vast majority of questions that have come in now. There is one just generally wanting to find out a little bit more information and a bit more background to the scheme and the estimation of methodologies and things. Is there a key place that you direct people to if they want to read about this in a bit more detail?
Yeah, sure. As George mentioned, we're actually releasing an in-depth toolkit to discuss all of this in much more detail towards the end of this month. So look out for that on the WSP website, being SECR toolkit. Also, if you want the official guidance, if you just Google SECR and government, there's a really good government holding page that has the impact assessment they undertook to look at the impacts of SECR. There's the consultation response document on there as well. So there's 3 or 4 documents that I'd recommend you look at. And also the specific provisions for what amendments they'll be made to the Companies Act and to the other business legislations, all on there. So look at the government website, and also have a look out for our toolkit coming in the next couple of weeks.
Yeah. Also, if you've got any further direct questions, we're definitely free to answer any further questions. I know there's a couple of sort of methodologies and things like that, but we're more than happy to answer any further questions if you've got any further questions.
Brilliant. Thank you both. And yeah, apologies to attendees for the disruption with audio that we had in there. But this webinar has been recorded and it will be made fully available on our YouTube channel. So any bits that you missed, make sure you go back and have a look at that. And like James and George have said, they're open to questions as well directly with them both. Our next webinar will be on the 14th of February, and it'll be with Simon Eklund. He's going to be the 4th part of our Entrepreneurship in the Environment series. So do tune in for that. More information is available on the website later this week for you to sign up. But a massive thank you to both James and George for your time and for presenting that webinar. It certainly provoked a lot of questions. I think it's going to be something that's going to be of a lot of interest to our members. So thank you again. So thank you all for logging in, and thank you to James and George for your time.
Yeah, thanks for having us, guys, and apologies again for the sound issues.
Yeah, thanks very much for having us. Cheers.